John, I don't know anyone that has been around the industry from all aspects as much as you have been. I mean, you have been an analyst, you've been an investment banker, you're now a venture capitalist, you're also an advisor in a lot of startups. You've seen it all if anyone has. And I think that's a testament to your success and legacy. Listening or thinking about what David Parker talked about this morning and just how the business has changed, what is your sort of general takeaways from the last couple decades?
Well, my career has been a combination of transportation and logistics and finance. And I was thinking the other day that probably 95% of my friends come from either finance or transportation, and the finance folks I know are like 99% involved in transportation. So my whole life is transportation. And when I first started out back in the sort of mid-'80s, I was at CSX. CSX had an operating ratio of 92. Their goal over 5 years was to get it to 85. I think last quarter they're running at a 60 or something. So the railroads have certainly come a long way over this time, but trucking had just gone through deregulation and was trying to figure out what to do. There were some transformational leaders in the industry like J.B. Hunt, Clarence Werner, Don Schneider, probably would be the big three, maybe Jerry Moyes. I'd throw in there Dwayne Ackley, Russ Jardine at Heartland Express. And they saw a big opportunity to haul freight of all kinds for all people at a relatively inexpensive price, because they were now free to serve all shippers. And they realized that if I had a low cost structure, that I could be very competitive.
And this is what, 1980?
This is, sort of late 70s, early 80s time frame. And from a financial point of view, some companies, we spent 75% of our time on skinny little metal tubes, flying all over the United States, talking to every single trucking company that would talk to us. So I was thinking about how many nights I've spent in the Chattanooga Marriott next door here, but it's got to be 30 or 40 over the years, at least, maybe more. I have no idea. Haven't kept track. But some people said, yeah, giving up some share of ownership might make some sense. It'll give me the capital to maybe grow faster. Maybe going public is not such a bad idea. And back in those days, you could do a very healthy IPO if you had maybe a $60 million post-money market cap. 60 million. There are some freight tech startups that started 6 months ago that have a higher valuation than that now, and probably don't deserve it, but have it nonetheless. So we took a bunch of companies public. Interesting story, a fellow by the name of Don Freimiller. I don't think Don is in the audience here today, but he had a refrigerated carrier, Bakersfield, California. And there were a certain number of things that he was doing that really weren't appropriate for a public company, and I'll leave it at that.
Is this accounting irregularities?
Beyond accounting.
Okay.
Okay. But I'll just leave it at that. And he went public nonetheless, had some issues. I remember there was a day when he called up and said, we're going to miss our third quarter earnings because light fly rot has knocked out the lettuce crop in the Central Valley of California. And I'm thinking, light fly rot, what the heck is that? Hey, Don, maybe you should have a more diversified customer base so that light fly rot doesn't derail your earnings for the quarter. But he came up to me at a TCA Refrigerated Division annual meeting in Park City, Utah. And he said, you know, John, the worst decision I ever made in my life was going public. He said, I had no business going public. And a company like that never could go public today.
Yeah.
The standards are much, much higher. And that's why we've seen so few IPOs in the transportation space over the last 5 or 6 years. We used to do 3 or 4 of them a year, and then multiple follow-ons. So it was kind of like the Wild West of finance back in those days. And it was a great way to meet everybody in the industry. And, you know, people like to talk about hunting. They like to talk about football. But what they liked to talk about most was trucking. And if you had the ability to talk trucking with people, you were befriended to them and they trusted you and said, well, you know, instead of going with the fancy guys wearing the fancy shoes and ties from New York City, we'll go with the guys from Baltimore who just feel better to us. And we had very, very high market share, which really agitated. This is when I was at Alex Brown and Sons, which was America's oldest investment bank at the time. Really agitated the people at Morgan Stanley and Goldman Sachs and Salomon Brothers, so forth. But we were quite
You're further south. You're
quite okay with it.
we're in New York.
Technically, Baltimore was below the Mason-Dixon line. So we were technically Southerners, and that played well in the Midwest and the Southeast and the Far West. So things have changed a lot. Now, the only companies that really have gone public in recent memory are really big companies like Schneider, UPS, Lineage Logistics. There was an auto hauler roll-up that went public earlier this year. I can't remember the name of it. That might be a bit of an exception. They've already missed earnings, I think, which is sort of the death knell for a trucking stock. But the companies that had the courage to go out there and go public in the early days, shortly after deregulation, have really grown into behemoths in the industry. If you look at Werner, you look at Knight Swift, you look at Schneider, you look at J.B. Hunt, they really are the industry leaders. And one of the big reasons that they've become industry leaders is the fact that they had access to capital and were able to make investments in the future and then pivot along the way brilliantly as market conditions changed. I remember Brian Hunt, JB's son, calling me up one day and saying, we just added 600 trucks in the first quarter, and it feels like we can't get the utilization on them. The shippers are kind of pushing back a little bit. I thought you said the market was like a, you know, $300 billion market or something. I said, well, it's a big market, but if you only haul 500-mile freight and you only handle drop and pick freight and you only operate in certain lanes, that reduces the size of your market pretty dramatically.
Yeah.
And I think that conversation may have, I don't want to take full credit for it, but may have sparked their pivot to look at things like intermodal, dedicated, integrated capacity solutions, JB Hunt 360, and all the other wonderful things that they're doing. They've really changed with the times pretty effectively. Companies that haven't changed with the times have struggled quite a bit.
John, the railroads were a disaster. You weren't credit for that. But there was a time when the railroads were struggling a lot. They have become immensely profitable. Like that's these businesses are in the 50s and 60s and 70 ORs. What do you attribute that to, and why is railroads so much more successful at scale than what you see out of the big truckload operators?
Well, in the early days, there was a lot of consolidation. If you look at CSX, for example, it's a combination of the chassis system and the seaboard system. The chassis system was made up of the B&O, the C&O, and the Western Maryland. and the seaboard system was made up of the seaboard coastline, no, the seaboard airline, the Atlantic coastline, and the Louisville and Nashville. Okay, so there was immense consolidation that took place, and that created all these internal culture wars, where, you know, if you were an L&N guy and you were a B&O guy, maybe they
Couldn't get along.
see the world the same way. Okay, but eventually, over time, all of that integration took place, and the executives of those railroads succumbed to the pressure from Wall Street to mimic what Hunter Harrison had done at the Canadian National, which is to implement a policy called precision railroading, scheduled railroading, if you will. And now all the U.S. railroads essentially operate that way, and that has shed a huge amount of cost while delivering an improved level of service. So that has really driven the cost structures down pretty
Truckload has
dramatically.
gone the opposite direction, where at scale these companies have just immensely struggled. Is there a dynamic that's different between the railroads and the truckload operators in your view?
Yes. In the railroad world, you're either in a monopoly or a duopoly, and you have this organization in Washington called the Surface Transportation Board, which is the last remaining vestige of the Interstate Commerce Commission. And it tries to create competition and make sure rates aren't out of line and so forth, but really they don't have much power. Railroads just take rates up, 5% a year, much like UPS and FedEx do, which is what you do in a duopoly or a monopoly. In the truckload world, the industry is still, even though you've had tremendous growth of some of these big players, nobody has enough market share to really control pricing. So when supply and demand loosens like it did 2.5 years ago, the shippers all of a sudden decide that they're going to push price down. And I know of a couple of specific instances where shippers came to carriers and said, oh, by the way, your rates are going down 18% on Monday. Here it is Thursday of the prior week. And if you don't like it, that's okay. We'll move on and use another carrier. That's pretty brutal. That's
They could never do that to a railroad because they would lose all that capacity.
No, you can't do it to a railroad because, first of all, there may only be one railroad that serves your facility.
Yeah.
You don't have service of multiple. So if you're smart enough to locate your plant like on a short line that has access to two railroads, maybe at the north end and at the south end, then you've got some ability to negotiate price. But if you're a captive shipper, you're pretty much screwed.
If they decide to exploit you. I was in when U.S. Express had a intermodal trailer on flat car. BNSF invited us to Montana, Glacier National Park, and they shut down the train. A beautiful train ride, by the way. Shut down the train in the middle of the park, and they asked for a 7% rate increase in the middle of the park. And you're like, wait, if we don't agree to this, are they going to leave us stranded in the middle of Glacier National Park? But that was the way the railroads worked. That's just that's how they operate. You're now a venture capitalist. A pretty significant change from doing late stage IPO work, raising capital of large private companies. You're now working with the smallest of companies, where you talked about valuation being completely in a different level. What is your sort of observations of what you see in the early stage of the business versus the late stage of the business?
Well, the early stage folks come in a lot of sizes, shapes, and forms, right? My favorite type of founder of a freight tech company would be somebody who's done it before, the second or third time entrepreneur, because the mistakes that they made the first time around or the second time around, they're probably not likely to make the third time around. So that experience is really critical. The second thing is they have to have a flair for marketing if they have a product that somebody like, you know, Schneider might buy, and they're sort of people with a technology background, they have no idea who to call at Schneider to try and get an audience. So it's always helpful to have somebody who actually knows the market, has some connections. That's really key to driving growth in the freight tech world. Essentially, you need two founders. You need a tech guy, and you need a freight guy, or gal, as the case may be. And they have to work together as a team. What we find is that single entrepreneur companies tend to struggle quite a bit. And the third thing you look for is a total addressable market that is going to support a company that can achieve great size relatively quickly in an environment where there aren't a lot of, and preferably there are no others trying to solve the same problem. Okay? And, you know, there was a time when there were, I don't know, 10 or 15 different digital freight matching companies out there. I won't mention the names. Some of them aren't with us anymore. But
We had Dan Lewis yesterday, so Convoy.
that's probably the most famous one in that group. But there's Transfix and there's others out there as well. LoadSmart would be one. And they're all basically trying to solve the same fundamental problem, to become technology-driven truck brokers. And none of them seem to have much of an advantage after spending hundreds of millions of dollars relative to companies like C.H. Robinson, XPO, Echo, TQL, who, oh, by the way, weren't standing still. During this whole period, they were investing tens and hundreds of millions of dollars themselves in technology.
Yeah.
So you could never really open up a competitive gap there.
I mean, it's all a commodity at the end of the day, right? Freight is a fungible commodity between two different participants.
I think that's probably less true than it used to be. I think like dry van truckload used to be a flat commodity. Now you've got companies, I don't know if you're familiar with ISO technologies, but you know, they rate brokers and carriers and actually rate shippers so that you can, with some specificity, see who's doing a better job and who's doing not so good a job. And you know, I think people are willing to pay, particularly if they have high value, time-sensitive freight, a little bit more for quality. You see that in the LTL space in spades. There are some people that really don't care whether the freight gets there in 4 days or 5 days or 6 days, and they're willing to absorb a certain amount of damage in exchange for a low price. And then there are people that say it's got to be there third day AM every time. There can't be any damage. All the bills have to be correct, and I'll pay a premium for that.
What are you bullish on? Like, what are you, the digital brokerage is obviously not something you're bullish on. Where are you bullish?
At a sort of 43,000 foot level, I'm bullish on America, particularly subsequent to the election. I think it's been a long time since, I would say, conservative Americans have controlled the White House, the Senate, and the House of Representatives. And I think that could lead to some very interesting things, with or without tariffs. I don't think tariffs are as big a deal as people are making them out to be. So I'm very bullish that finally we're out of this sort of funk that we've been in. I spoke at the Truck and Trailer Manufacturers Association annual meeting about a month ago up in Coeur d'Alene, Idaho, which if you haven't been there is a beautiful place. And there were a lot of suppliers to the truck trailer industry there, and they were talking about how flat on its back the industrial economy was. Remains very flat on its back, and is if anything getting worse. Okay, so all of the 2 and 3% GDP growth numbers that we had seen were sort of related to government expansion, healthcare expansion, the service sector, airlines, hotels, restaurants, amusement parks, that type of stuff. But manufacturing is sort of flat on its back, and that's the core of our economy. And I think that's the piece that's really going to come back with a vengeance here over the next couple of years. People psychologically feel better knowing that their government doesn't view them as evil.
Yeah.
Okay? So I don't want to get into politics, but
I think we just did.
You can probably tell me where we're headed. I would have jumped for joy if Craig Fuller had been named the Secretary of Transportation, by the way, because what a unique concept to have a guy who actually knows what he's talking about running the Department of Transportation.
I got beat out by the real world, so the real world guy.
You know, maybe next time. Maybe when JD is president.
We got 4 more years.
He'll,
right?
he'll
my campaign has started, so we'll keep that conversation going.
Yeah.
So John, just in terms of freight tech specifically, because this is really what this event is about, where would you be placing your bets? What is your message to a founder in the room about if they're thinking about starting something? What would you say has the best promise of issues to address or technologies to bet on?
Well, I think there are a lot of what I would call administrative, operational areas in transportation and logistics that burn up a huge amount of human resource. I think of a company like Highway, which came along right at the right time to try and deal with all the fraud that exists in the freight world, and they've had great success in helping to solve that problem. I think about a company like Q'd, which is doing automated appointment scheduling, and that company is run by a guy who's built 2 other companies, who knows everybody in the industry, and it's easy for a company like that to scale quickly before somebody else has the idea and tries to replicate it.
Because to your point, he's had multiple startups, multiple exits, has been in freight before.
Yes, so he's a known commodity to the customers of these systems. So I think any time you can basically put a piece of technology into place that's going to eliminate people or make the existing people more productive, and there's a fine line there between those 2 arguments, I think you've got a shot if you have a workable technology that makes economic sense to the buyer to get it out there in the marketplace. But you've got to be able to ramp it quickly. There's a couple of companies that have good ideas that I work with who have not been able to really sell it to this industry, haven't been able to ramp, and they're just sort of hanging on for dear life, kind of by their fingernails.
You said something that I think is something I've thought about a lot. If you look at the most successful companies in our space, the one thing that you have, and I'm talking venture startup companies, is a founder or multiple founders have come from the industry. And you can go through the list. You talked about Highway, you talked about Q'd, you talk about, we're talking Jet McCandless, Project 44, we're talking Andrew Leto. These guys have been around the industry. My Carrier, all of those guys. And you can go through the list. That is consistent. It is hard. It was interesting because Dan Lewis used to be my exception to that rule. And I would say all of the founders that have created successful businesses have come to this industry. And I was trying to give Dan Lewis the benefit of the doubt, but we know that didn't work out. I suspect Dan's second generation in this industry, if he does choose to do that, will be far more successful because he's now paid the price of what the industry has taught him.
What people don't understand about this wonderful industry that has been kind to everybody in this room is that it's very complicated, and there's a lot of nuance, and there's a lot of segmentation, and it's very difficult for the smartest guy in the world to come in out of left field into this industry from another industry and have immediate impact. One of the companies I serve on the board of, I don't think I'll mention it, but brought in a CEO from a bathroom fixture manufacturer, okay? And let me tell you, there's not a lot of similarity between producing, toilets and running a truck line. Very few similarities. And it doesn't matter how smart the person is, how well educated the person is. This is really difficult to ramp up, even over the course of a couple of years, to understand every nuance with every customer, every piece of equipment, all the technology required to support the business. So it really is key that if you're thinking about starting up a business and you're a sort of a tech-oriented person, make sure you partner with somebody who's really ingrained in the freight business.
Yeah, I think having that tribal knowledge, if you will, is the most important component in this business. Well, John, unfortunately we don't have any more time, but really appreciate your time. Folks can catch you. You're at Venture 53. So if there are founders looking for capital, is this something you guys are open for business?
Yeah, we're currently raising Fund 3. Fund 2 is mostly deployed currently. It really has some great companies in it. We're very excited about the future of many of those companies. But we should be able to start making investments sometime early next year out of Fund 3. But we're trying to stay abreast of all the companies that are available. Even though we can't necessarily invest today, we'll be able to invest very shortly.
In closing, I think the thing that Venture 53 has that's common with what we said successful founders is the founders of Venture 53 and a large number of the LPs are industry people.
Yeah, I think all the LPs are industry people, and the LPs can help you source deals, vet deals, and actually coach the entrepreneurs to the extent you want to. If you don't want to get involved at that level, that's okay also. But it's sort of an organization that's made up of people that have spent 100% of their time for the last 25 years or longer in this space. And that goes a long way towards avoiding sure losers. Mm-hmm. If you go out to 2 or 3 of your LPs and say, what do you think of this product? And 2 out of the 3 of them say, that'll never work for this reason, this reason, and this reason. That's enough for us to say, well, we'll probably take a pass on this particular investment opportunity.
Well, John, thank you so much. I appreciate your time.
Good to be here. Thanks, Craig.